Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Marcus Long, founder of Long Legacy Capital, has transformed real estate investing to create impact and legacy with over $95 million in assets and extensive experience. He's a mentor and a coach dedicated to family, education, and community. Marcus, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, thanks, Josh. I appreciate you having me on and the opportunity to share with your audience as well. I'm a husband, father of a 9 and a 6-year-old, and I spent a little over 21 years in the military. Just transitioned out of the military about 15, 16 months ago or so. And so I was a cryptologic warfare officer for a couple decades, doing signals intelligence and opportunity to serve on ships, submarines, aerospace data facility, as an exchange officer to the United Kingdom. And so pretty wide range of experience, and enjoyed that for a long time. But, towards the end of my career, as I had a couple little ones, kind of decided that I wanted to transition into something a little bit more conducive to raising the family from a lifestyle perspective. And so I had invested in real estate, most of my military career, and not necessarily super intentional or focused early on, but as I kind of got towards the end of the career, decided that was the medium that I wanted to continue to serve others in my post-military life. And so kind of started getting more focused and systematic about it in the last couple of years, and that's what I transitioned to doing full time after the military.
Tell us about your first deal in real estate, how that came about, how you financed it, managed it, and on from there.
Yeah, so the very first property I had, at the time I didn't think of like as a quote unquote deal, if you will. I was about 22 years old. I had enlisted in the Navy right out of high school and had been selected for a commissioning program, and they sent me back to the University of Missouri. So go Tigers. To get my degree and my commission. And when I did so, I bought a 3-bedroom, 2-bath condo, in an HOA. And I was thinking about like me living there personally. My family had a farm about an hour away. And so that's part of the reason I got a condo, is so I could spend some time back helping on the farm and training horses and stuff on the weekends, and not have to worry about, a yard and all that kind of stuff. And I ended up renting a couple rooms to friends of mine. So kind of house hacking before, the term was coined probably. And when I left after I graduated, I continued to hold it as a rental. And I actually still have that property today, but, didn't necessarily look at it as a rental investment property early on. I used my VA loan. So at the time, I didn't put any money down on it. And I think it was just I knew real estate was a kind of a path to wealth and stuff from a pay down of the pay down the loan and the appreciation. But I think it was, having someone live there with me, paying the mortgage, and then continuing to rent it and seeing the equity that I had in it after I left, that started making some of those things kind of click, and kind of led to my path to acquiring more real estate later on. So I kind of, managed it myself while I lived there. And then I brought in a third-party property manager after I left, and was, deployed and stuff like that.
Got it. So now you're sitting on $95 million worth of real estate. That had to start with a larger property, a much larger apartment complex. Can you tell us about how you came about that, and how you even led up to getting into multifamily?
Sure. Yeah. So for most of my career, from that very first one until the last probably 2 to 3 years, I was mostly focused in single family, and periodically acquired a single family, mostly like as a rental. And at the time that I kind of moved into multifamily, I probably had about 15 or so doors. So not like a massive portfolio or anything, a small single family portfolio. And I knew that I had a lot of what I'd done to that point had been kind of opportunistic, right? Like as some opportunities, mostly back around my hometown or in Missouri, where I was originally from, became available. I acquired them, I rented them out, but I wasn't always necessarily super systematic about looking for new opportunities and the pace at which I was acquiring them. But when I made that decision to start my off ramp out of the military for family reasons, I knew, as like, if I'm going to go real estate full time that I had to be more systematic about how I did that. And I looked at, by this point in time, started getting education on a lot of the different strategies that are available. And, through a lot of conversations with friends and mentors and partners, decided that multifamily was the path that I had desired to go. And my final tour was actually in the United Kingdom. And when I moved to the United Kingdom, I had invested passively in a handful of syndications, multifamily and mobile home park syndications and stuff myself. So I had become more familiar with, that strategy and the benefit of passively investing in them. And, I kind of just desired to move in that from an active role and to share those opportunities with a lot of my, my peers and friends that I had connected with over the years who continued their military careers and were stationed all over the country or throughout the world that might, want to be invested, but don't necessarily have the time or desire to, learn to be on the active side. And so I had some close connections that I had through masterminds or other military friends that had started becoming general partners and stuff, and kind of talked to them and said, hey, like, here's the value that I think from my 15 years in the real estate industry that I can bring to a general partnership team doing syndications, and kind of started to partner with them. And how it goes when you deliver value to a team, and they delivered a lot of value to me, and things kind of started rolling from there. And here we are 800 plus units later.
Yeah, no, it's definitely finding your superpower and finding out how you can help others and help others get their time back too. That is tremendous value to a team, and that helps scaling as well.
Absolutely.
What areas are you all investing in?
Geographically?
Yeah.
Yeah, so primarily a large portion, probably about 50 to 60% of my portfolio is in Tulsa or in the Tulsa MSA. Have about, maybe another 25% in Texas, and then the remainder in kind of the Nashville or Murfreesboro, Tennessee area.
Got it. What are you seeing with your all's occupancy and rent collections and so on and so forth?
So I would say overall, particularly, I'll speak to Tulsa where a bulk of it is. Most of our stuff is pretty good, 95 plus percent occupied, some close up to 100, except just the monthly turns. Probably our lowest performing property in Tulsa is just under 90% occupied, but our collections across the board there are pretty solid, and I think that speaks a lot to. We have a really, really good third-party property management team that we have. We see them as a real partner, and they manage all of our properties in the Tulsa MSA. And I think just the culture that we have created as a team with them, and then the culture that we create in the communities that we tried to build at those properties, from the beginning, bringing in the right residents to live there, and then just the way our on-site teams interact and engage with the residents. And sometimes there's some gamifying it. We'll do like a raffle for everyone that pays on time and stuff. We'll throw them in a raffle for a free TV or whatever it is. Different types of things like that. But I think a lot just goes to the community and the culture that we create there. So really good in Tulsa, and really in Texas. Our property, we have some stuff in College Station around Texas A&M and stuff that's pretty solid. And I'd say down in Nashville, not bad, probably not as good as our Tulsa stuff because of a lot of the new builds and the competition that has been there. A lot of the new builds I think are having concessions and things like that. So there's some, even if it's not a direct competition from a class perspective, them just trying to build up their occupancy. There's some competition there.
What class are your all's assets?
Yeah, I would say majority of our stuff is probably C plus, B minus assets, with the exception of our College Station asset, which is 2012, more of an A class.
Got it. Do you all mix it up with subsidy programs?
We really haven't messed with, I shouldn't say messed with, but we haven't really dealt with any subsidy programs really today, other than, a number of, particularly like COVID, and then after, there's programs and a lot of programs in Oklahoma and stuff that help with residents, on a case-by-case basis when they're in need, fulfilling that. But from a Section 8 or anything like that, we don't have any of that in our communities.
Got it. Yeah, and we've done quite a bit, and it's just, I mean, just like clockwork. Every month the rent comes in on time because we're in C plus to B, I'd say B minus workforce housing. So it's not bad to integrate maybe like 20% of the community in with subsidy programs. So you just got to do your screening and make sure you check all the boxes. But for the most part, it's not been bad. It continues to perform month over month. It just helps offset the market rate and then chasing down rents too. Um, what as far as your third party property manager, how many units do they have under management of your all's?
So for us, I think we're probably somewhere between 500 and 700 in Oklahoma.
Got it. Yeah, they've got a very vested interest with you all to keep you happy. Then
We're about 20, I think probably 25% or so of their overall portfolio.
yeah, and then of course you get economies of scale on their side too with asset management and crews and turns and I'm sure material purchasing. So it kind of balances out for sure.
Yeah, there's a lot of benefits. I mean, they've really helped us, as owners look for efficiencies. We've recommended some stuff from a property management perspective, and they've been very open to implementing different ways, like communication and stuff. And as you mentioned, like the economies of scale of material, manpower, and when we get to that point, that number of properties in the portfolio there, not only generally we have one leasing person, one maintenance person per property, around 100 units or so. But when we get to that many, we can kind of afford to have some like floater maintenance people or, some specialized people that can bounce between and help different properties and spread that cost across the different ones. So, yeah, certainly there's been a lot of benefits to both sides. From even an efficiency of communication. When we do our asset management day, it's just 30-minute calls right after one after another. Instead of bouncing around with different formats and styles of different owners, they get to work with one owner that entire afternoon of communication.
Yeah, that's huge. Are you all doing a business plan, value add, renovating the units, and then leasing up from there?
Yes, so I would say that most of the acquisitions that we have are probably in the ballpark of 94 to 96% occupied when we acquire them. So they're generally fairly like stabilized from an occupancy perspective. Sometimes they just aren't really necessary. They're below market rents a bit, or there's some efficiencies in operations. Some of them occupancy was very good, but they didn't necessarily have to upgrade units a lot to keep it occupied and stuff. And so generally that's stabilized cash flowing when we acquire them. But there are probably more in the true sense, probably more core plus. There are some value add components, if you will, both from upgrading units as well as some of the operations. So not a lot of needing to increase occupancy, but we're able to increase rents, as we do some of the updates.
Got it. What kind of updates are you all doing when you do renovate?
It's a little bit, even though it's all Tulsa, it's a little bit dependent on kind of the submarkets because, for example, one submarket, maybe we do some, new flooring, new paint, maybe it's upgrade some of the countertops or something. So some of them are a little bit more cabinets and things of that nature. And in another submarket, when we acquired it, the previous owner really wasn't doing much kind of upgrade. They just took care of the basic maintenance in the term because they were staying 100% occupied, right? And so, and they didn't really think that, hey, we can or need to upgrade. We're not going to get the value from doing that. And so we just acquired one less than a year ago, testing a few with some minor upgrades to see like, hey, can you bump the rents enough to make it worthwhile, or do we need to do that? And so it's kind of even submarket specific as to, what quality or which ones we do.
Yeah, for sure. You got to weigh out what the comps are, and some cases you can be a market mover just by adding on some different amenities, even like a granite countertop and new hardware. We typically do the black, white, and a gray color scheme, final plank flooring. We found it easier to keep the units leased up and easier to lease immediately when just have more modern looks renovations. So it's but
Yeah.
it does cost money. So there's pluses and
100%.
minuses.
That's the one I was mentioning before. When we first went to walk it, the units weren't necessarily in bad condition, but you'd walk in and, the appliances, there'd be a black appliance and a white appliance and maybe a stainless steel appliance, or just mixed match of whatever was available and stuff. So sometimes even just like having everything like, match and look the same is an upgrade from kind of walking in and it being kind of a hodgepodge of different things.
Yeah, for sure. So when you help your potential investors figure out passive investing, what are some things that you talk about, and maybe some nuggets that they don't know about?
Yeah, so I think that, about 75% of my investors at the moment are kind of military connections, either of my own or my wife. She's on active duty as well. And so, across a couple of decades of military connections. And so some of them have never really invested in real estate that much previously. Some have, some single family rentals or different things like that. Some maybe have invested in syndications before. So various levels of experience. But I think, a lot of people, when they think about investing in real estate, they think of like having a long-term rental or something of that nature and just don't know the various options or strategies that are out there. And so as I start to have these conversations with a lot of my potential investors, one of the first things I really just want to understand, like, what is their goal, financially and like as a family and stuff, and what are they looking to get out of it? And when I say that, like, financially, maybe it's like, are they looking for cash flow? Are they looking for, maybe they're content with their paycheck and stuff. They just want the growth over time. Are they looking for tax benefits? Because across real estate, there are different strategies that might be, better or worse for certain ones, pros and cons. And then as a family, trying to help them if they're just like, hey, I want to get into real estate, understand like how active or involved do they want to be in real estate, or do they legitimately just want to be passive? They want to be hands off. They just want it in their portfolio. So really kind of digging in to see kind of what they are looking for, and then trying to help, give them some options of like, hey, maybe, what we do in multifamily and syndications is a good avenue because of X, Y, and Z. Or maybe, I have a military connection that says, hey, I've got this bucket of capital, but we'd like to use it for a down payment in 2 or 3 years when we PCS to our next duty station. Well, the syndication is not the right option for you because your money's probably still going to be tied up. But, maybe I can help you get into private lending or something else that you can have your money back in a shorter term. So trying to help them, understand that there's some different options out there that may or may not align better with their goals.
Yeah, that's huge. Just discovering those different options too, instead of just the stock market, and then you're out of total control. What are some skills or lessons that you've gained through the years of being both in the military and then multifamily?
Yeah, so I think that hopefully there's quite a few of them, but I think a couple of things that like transition. Some things I probably started to get from the military and maybe transition into multifamily. I think both from like a leadership perspective and building teams and communication. Some of my latter tours in the military, I was working a lot with contracts, and whether that was putting together teams of different contractors or trying to raise capital from different organizations to acquire equipment and programs and things like that. And so I think being able to communicate and to tell a story and, try to help people understand what the objective was, whether that was to, people that worked for me or for people that might be bringing capital to help run a program and stuff, has transitioned a lot for me into what I'm doing today. And so like, when we put together a business plan, as our team and the general partners, being able to kind of to tell that story to potential investors and help them kind of understand it, because, it can be, I don't want to say complex, but there are a lot more moving parts, and, there's like this legal paperwork and there's like more partners involved than we think of on like single family teams and stuff. And so being able to sometimes simplify, tell the story, but to be able to simplify that where they're not confused and stuff, I think is probably one of the things. I think another one that kind of comes from the military is just our ability to be flexible. A lot of times, I say we train for half of a year to go to a certain geographic area in the world in the military, or maybe train for a certain mission, and then right at the last minute, your mission's changed, or you're going to a different part of the world and stuff, and you just have to kind of be flexible. And I think that happens in real estate and multifamily and commercial real estate and stuff in general, is that we know that there are going to be things we have to expect the unexpected, right? And things that will come up, and just have to be prepared. Like, okay, that wasn't part of the plan, but we prepared to be hit with some stuff that wasn't part of the plan, right? And to be flexible, and how do we adjust and go from there. And so those types of things aren't really surprises, and kind of keeping the blood pressure low, instead of getting spun up and stuff. When that kind of stuff happens, just taking a deep breath and being able to approach it.
Yeah, definitely be flexible, and entrepreneur spirit is to just adapt and pivot and make quick moves and decisions and make it happen. But yeah, it's what it's about, especially real estate. Real estate's slow moving though too. Things will happen, but if you keep your finger on the pulse at the community level, then you can gauge your tenant satisfaction, or what things can need to be changed, whether it's management or survey scores on your maintenance, or response time on your maintenance, being able to reach people at the office. You can keep your operations tight, keep your tenants happy as if they're your customers, and that helps a ton.
And I think that's important for us to, sometimes when you're starting in a certain strategy or real estate or whatever, you might not be prepared for that. And so you might plan for, I don't want to say best case scenario, but you might not take some of that stuff into account. Right. And so I think, as we do, are involved in more opportunities, more experience and such, we learn to kind of plan for some of that. You don't know what it's going to be, right? It might be a fire in a building. It might be a car running into your building. As you said, some of the, just like maintenance response times or tenant satisfaction or whatever that might be. It could be small, could be big, but we are able to kind of plan for some of that stuff happening up front. And so when it does happen, it might not have been part of the plan, but we, can kind of take some of, can adjust from it, and it doesn't kill us because we kind of, prepared financially or from a time perspective to be able to account for some of that.
Yeah, for sure. Absolutely. And then of course, underwriting and what is the effective rent roll, and is that going to be the same when you take it over? Because there's always a disruption when you take over a property, and then you find out what happens. Very cool. What has been a surprise, I'll say, after you all have taken over a property that you didn't take into account?
Yeah. So, I think on a couple of the very early properties, we dealt with some things that were like, the occupancy not being quite what it was said to be. There were some leases that were, we did the digital due diligence on the leases and stuff, but unfortunately there were some operators that went into a lot of work to make things look like they were something that they weren't, right? And so I think a few of those kind of surprises helped us with some of our own due diligence processes and verifying some things, during that process and stuff before closing. And so as you do a couple of those acquisitions, you'll kind of learn. And a couple of our early acquisitions were when I was still, a couple of the partners, we were still stationed in the United Kingdom. It was during COVID time. And while we had partners that were local and stuff, there were certainly a lot more challenges to try to overcome into verifying some of that stuff. But they have certainly come into play as we implemented processes and further acquisitions.
Yeah, for sure. On all of your all's acquisitions, they're all syndications. What's your all's typical structure that investors can expect?
Yeah, so for the most part, we are kind of a 70-30 split, probably in the ballpark of 7% pref, something like that. Anything else in the structure part, or is that pretty much what you're asking?
That's pretty much it. And then what are you all seeing out there on your acquisitions pipeline? Are you all still purchasing, waiting for things to settle in?
Yeah, so I mean, we've been fortunate, even with last year being a pretty slow year, I think, across the board for a lot of people. We still acquired a little over a couple hundred units, a little over 20 million in acquisitions there. And so we had, some of those were just relationships that we had developed. And that's really where a lot of our acquisitions are coming, is not necessarily stuff popping up on the market, but just like developing relationships with potential sellers Sometimes with our property manager, when she knows another seller that's looking to offload something, some different things like that. And so while we have some of those acquisitions were longer, took longer to get them closed because of stuff going on in financing or negotiations or things like that. They were a longer process than many of our previous acquisitions were, but we've still been fortunate to kind of continue a fairly steady acquisition. So that said, going into this year, we will continue to analyze and to make offers, but we're really focused on the team's really focused on dialing in the operations and stuff as well. I think we have some phenomenal asset managers that do a great job already, and we're just trying to kind of take that to the next level, because when we look at some of these past few years where the market kind of could help people ride a little bit, or there's just constant rising rents and stuff, and when that's not happening, I think we really got to dial in the operations to make sure that we're running efficiently as possible.
Yeah, for sure. And now's a great time to keep on sharpening the axe and get hone in on operations, as that's the operations is the bloodline. The tighter you've got everything and finger on the pulse, the better it runs, for sure. Very cute, Marcus. If somebody wants to reach out to you and learn more about yourself and your all's company and how y'all do things, how can they get a hold of you?
Yeah, you can always go to alonglegacy.com. That's alonglegacy.com. There's a page on there that has a calendar. If you want to set up a call to connect with me, my email address, marcus@alonglegacy.com. My social media is all on there. So yeah, if anybody's happy with it, they're just getting started and trying to figure out, what a good strategy for them to go in is, or just want to connect and chat, hear more about what we're doing, happy to talk to them.
Awesome. Marcus, we definitely appreciate you coming on the show, and certainly look forward to following you, and we will talk soon.